Hey, what's up, traders? Trader Tim from E-mini Mind, bringing you a Monday market analysis. Today's Monday, August 24th, 2015. It's been 2 weeks since I've done a video. The last couple of weeks I've been traveling a little bit. As I mentioned just before I left, August can be a interesting month. There's a lot of things that often take place in towards the end of the summer that kind of lead us into what the fall trend is going to be, and this August is no different. So um, I guess I wouldn't say pleasantly surprised, but not overly surprised to see that the market did break down from our retracement that we've been in really since almost the beginning of the year. In 2015 the market has just moved sideways. We've come down to the 2040 level a number of times, almost a half dozen times, and every time we got a bounce, but we were never able to get a whole lot of follow through, taking us up to that 2150s. Every time that we did touch, we had sort of an immediate reaction. And so last week, when we not only just touched and traded through, but broke below these swing lows, that was a very telling sign that the market was going to, things have changed. Obviously, the breadth of decline or the scale of decline was not really foreseeable, but the fact that we broke below swing lows, that's a red flag for, okay, something has changed. Just like when we break above swing highs, that can be a sign that the market is gaining momentum. So breaking down, in this case, the market is gaining momentum to the downside. So now, where do we go from here? I'm going to pull out to, let's just go all the way out. We'll go 20-year weekly chart, and I'll get rid of our little fib up here. I'm not going to worry about drawing retracements on the big chart here. Actually, I'll go to a monthly chart just to clean it up a little bit. But you can see when we go to a larger time frame, this move that we had here is really not quite as big as it seems on the daily chart. 2000 crash is here, the '08 and '09 recession over here, and now we're still in the 1900 level on the S&P, relatively close to highs if you compare to back when we sold off in the 2000s. Just getting up to the recent highs was an achievement. So pulling back again in the recession, and not only making it to highs, but making new highs. This was a very healthy move. So having this sort of a pullback on a more grand scale now really becomes the time where a lot of money is actually made on a longer, bigger picture horizon. When we're trading, a lot of times we're looking at very small time frames, getting in and out on a daily basis. But when you're looking to add to, longer term positions, when hedge funds and big organizations are looking to invest money in the markets, it's kind of these periods down here where, at the time, if we kind of let's just pretend we don't know what's going to happen. At the time, it looks pretty scary. But when we are in these big declines, it's often paired with, almost always paired with higher volatility. So the reactions can be very strong. And really, the reward to risk is at its highest because, your upside, just making it up to prior highs, is quite a bit larger than the downside of breaking lows. Even if you were, let's say, trying to get in around here, and the the market didn't make its actual bottom, or let's say you got in back here when you noticed that there was a bounce, and then the market went a little bit lower, that's okay. You don't have to get into, the longer the time frame, the less specific your entries need to be. But when we go back to the larger picture, you can see that, buying way back here obviously doesn't seem to be that absurd, or it doesn't seem to be that low when you take a look at what the market has done. So, if you just kind of picture the market here pulling back down to, let's say, 1500, or coming down to these highs back here of the 2000 and 2009, the market pulls back that far, and to be able to add to some longer term positions and to be able to capitalize on a lot of movement and volatility in the markets, and then be able to ride those moves for another 2, 3, 4 years as the market then continues its cycle and we get through the next pullback. It's that kind of cyclical, big picture, little picture, back and forth that we need to take into account. So there's no really need to be super fearful at this point, or cash out all your investments and put everything into cash, especially if you have a lot of longer term investments, because at the end of the day, collecting those dividends and allowing the market to move up and down, but continuing to add to your portfolio is one of the best ways to grow your nest egg. So where do we go from here? If we go back to the smaller time frame, with the tick chart is a great way to capitalize on the markets. Very small time frame, you can get in and out rather quickly. You're not stuck holding overnight. You're not very involved with the markets, so to speak. And if I go back, on the tick chart, there's a ton of actionable trades, because there's 512 ticks per bar. Well, when the volatility gets high and we have all this volume, the tick chart begins to move very fast. So in these kind of environments, I love looking at the tick chart and not necessarily trying to buy bottoms or draw major fibs. I mean, you can draw some larger term, and like this retracement from this morning, visible on a 15-minute chart, but I'm not really looking to take blind 15-minute setups. I'm just looking for smaller time frame actionable trades. And when we get into these very fast moving markets, those small trades, for instance, just taking out the swing high here with this nice little move up and then drawing your fib, sometimes they can be a little bit choppy or a little bit dirty, but your range here is still, a point and a half. So even though the market is more volatile, you're still limiting your risk to 6 ticks. And so looking for some actionable trades on the smaller time frames, the market will kind of give you more when the volatility is higher, and produce a lot more setups. So we don't necessarily have to look to buy the bottom or be concerned with long or short, but you can just see how if we go through the 512 tick chart and just looking for things like these double bottoms and the break of the swing high, just very simple actionable setups. So my recommendations here as we go into the next couple of weeks, typically the September FOMC meeting following that is when the markets shift into gear and get super technical again, and things really start to click from a trading perspective. And that will occur, I believe, let's see, September. Wednesday is the actual meeting, and Thursday, the 17th, is the actual announcement, FOMC meeting announcement. So it's on Thursday, September 17th. So following that, and there's actually a quadruple witching on Friday in terms of expiry. So the Monday following, basically, halfway through the month of September through the second week, roughly in December, we should have some great trading opportunities. And so if I go back to the daily chart, we're not going to be super concerned with, like I said, the larger time frames in terms of trying to take a blind limit short if we do come back up. But because volatility is higher, the smaller time frames will then yield more opportunities and bigger ranges, which essentially can mean bigger profits. So that's kind of what I'm looking forward to as we kind of finish up the month of August and get into September. I'm going to continue to tread lightly here, not putting on any major positions in terms of big daily moves. We've got this low back here at 1813. There's a good possibility that we stay inside this candle for a few days and then start to roll over. But what we want to look for in terms of a major shift after we get these, big body, big body, big body candle to the downside is, some break above the previous candles, or some candles that are, big body to the downside, followed by big body to the upside, downside up to upsides. Some very big volatility, maybe some gaps in there. Some very big ranges rather, and that's what kind of, when you get the fight between the bulls and the bears, and you get these big up day, big down day, big up day, that's when you can get a little bit of a shift and either a short-term push higher. And typically, when the market is coming out of a big sell-off like this, that's when we get these super violent moves, super strong moves. And so even just adding to a longer term position when the market's selling off heavy down here, you're buying at 1880, even let's say 40 points higher, 1920. Well, the market is coming off of 2120s. So it can be a really good opportunity when the market gets like this and super volatile and these big down days like this to step back and not think so much in terms of day trading, but think in terms of adding to some bigger positions. And that's really all there is to it in terms of keeping things simple on the longer term investment front, because then when the market does cycle around, you've got more shares purchased or more contracts purchased at a lower price, and collecting dividends all the way up. And so it's really healthy for the market to do this. I think people forget that. Obviously, there can be unhealthy things economically that are sort of the catalyst for some of these moves, but at the end of the day, the outcome, the resolution is healthy for the markets. So I'll leave you with that for today. If you do want to chat more, as always, feel free to shoot me an email. I think I've gotten through all the emails that were sent over while I was away, but as always, my door is always open, and that's just tim@emoneymind.com. So thanks, be safe out there, tread lightly, and we'll talk to you next week.